Hi everyone, and welcome to today's webinar, Strategic Planning During Volatile Times. My name is Jeremy Green, the Manager for Marketing here at 3SI, and with me today is your presenter, Jim DuBois, Vice President of Consulting. Jim is a Principal Consultant at 3SI. For the past 15 years, his work is focused on strategic planning for small to medium-sized energy companies, scenario generation and comparison, value chain analysis, and complex risk analysis. Jim has worked for clients across the globe, including Europe, Asia, and the Americas. Jim is an expert in the critical elements of portfolio management and has extensive knowledge in the oil and gas industry, which he gained while working as an engineer earlier in his career. This allows him to bring an insider's perspective to his client engagements. One of Jim's passions is taking the complexities out of portfolio management and making them as clear as possible. Over his career, he's authored numerous technical papers, magazine articles, and presentations. During today's webinar, if you have any questions, you can send them directly to us via the chat window within WebEx. We will save all questions for the end of the webinar and answer them at that time. If there are any questions we are unable to get to, we will send direct answers to you via email after the webinar. And so with that, I'd like to hand it over to Jim for today's presentation.
Thanks, Jeremy. Recently we held a executive breakfast in Houston on the same subject, strategic planning during volatile times. Now, the content was different, but the subject matter, the theme of the breakfast was the same. We posed the question to the group, what do you think is different about strategic planning during difficult times, or during the times we're facing right now? Times when prices are not only low, but I guess unexpectedly low, where previous plans are no longer viable in the current environment. And between the answers we got there and some thoughts of my own, I've come up with these 5 major things that are different now than they may have been a year or a year and a half ago. The first one, and this is almost a direct quote from one of the participants at the breakfast, is that we need plans that help us survive in the short term while retaining a long-term upside. And that has implications around needing tools that can handle different goals, different targets in different time frames. I'll address each of these 5 in a more detailed slide later. The second item that came up is there needs, in difficult times, or times when prices have changed dramatically, there needs to be a greater emphasis on financial metrics during strategic planning. Where previously in stable times, getting your production, your reserves, and your CapEx in line may be enough, in the current times, managing your debt load, managing your debt ceiling or debt covenants can be a critical part of your planning process. Third one is that there needs to be a greater emphasis on uncertainty. I think this is amusing. 2 years ago, many companies didn't really want to talk very much about looking at uncertainty in their portfolio. They thought that their future was pretty certain. In fact, it wasn't, as we know now, that things turned out quite a bit differently than they had planned on. So in tough times when margins are small, we want to think more about what's the uncertainty in our portfolio. The fourth one, and this is probably the one that most planning professionals live every day, is that management requires and analysts require more scenarios to be run, and the turnaround time for those scenarios tends to be quite short. There are scenarios around changing prices. There are scenarios around changing costs. There are scenarios around different recovery scenarios. So will prices rebound quickly? Not at all, slowly. All of those scenarios have implications for how we might run our business, and we need to understand them all. And finally, a little bit on a different note, during a crisis, when things have changed dramatically, opportunities abound for those who are prepared to take advantage. So we want to be able to take a look at buying and selling fields, projects, even companies within the context of the portfolio. Let me get a little more detail on each of those before we move on with a kind of an example. First item, we need to survive the short term while retaining a long-term upside. And this means, as I said before, that we may have dramatically different goals in different time frames for the same portfolio. Let me call your attention to this graphic at the bottom. You'll be seeing this type of graphic quite a bit during the webinar, so let me take a minute to explain it to you. We have here 3 metrics. Later we'll be looking at 9, but now we're looking at 3 metrics. Production over about a 15-year time frame, CapEx over the same time frame, and debt over the same time frame. If I have a red bar, that means that I have a goal in that year that must be met or exceeded. So production must be at least as good as this red line says in order to meet the goals of the company. A blue bar is the opposite. It means that capital must stay below the blue bar. So capital is a limit, debt is a limit, production is a target or a goal. And the red line is the expected value result of a portfolio of some sort. In this case, it's just an illustration. In this case, we have a company that, for whatever reason, has a requirement to stay under this debt level, and they're not doing it in the short term. And they have a requirement to stay above this production limit, and their current plan is not doing it for them. So they have, in this case, at least 2 different targets in different time frames and different metrics, and they need to find a portfolio under these conditions that meet both of those goals and any other they might have. Short term, we tend to think about cash flow, debt management. We tend to think of capital as a lever. Long term, we tend to think about sustainability and growth, production growth, reserve growth, income growth, value. So the trick has always been to balance these. In volatile times, it's even a bigger trick. Next, we talked about financial metrics. So in good times, when prices are stable and we know what to expect, it's usually perhaps not sufficient, but seems to be enough that we can manage our spending and manage our production, and most things will fall in line for us, particularly if price is nice and high. When prices drop dramatically, though, any company that may have levered themselves in order to take advantage of the better times can suddenly find themselves in a debt or a cash flow crisis. What this implies is we need to have tools where the financial metrics are as much a part of the scenario building as are the operational metrics. There are many tools around that you can certainly run operational-oriented scenarios, and when you find one you like, you can plug it into a financial model and see what the results are. But we need to be paying attention to financials during the optimization itself so that taking care of our financials becomes just as much part of a successful scenario as anything else. When times are uncertain, there's greater interest in and emphasis on uncertainty. Because margins are small, uncertainty can do quite a bit more for us. Again, let me talk about my graphic here a little bit. This is not the same example, but it's the same type of graphic as you saw before, production. Now we're looking at EBITDA and debt. The same limits, the same red line for the expected value of the portfolio. But now we have added a black line, which in this case happens to be the P90 of performance, the blue line, which is the P10 of performance, assuming you follow that convention of P10 is large. And we see some little green diamonds. The green diamonds correspond to the axis on the other side, and they start talking about what's the probability of actually meeting the goal. So you can see here under production, expected value-wise, we have just barely exceeded our goal, but in fact, the probability of exceeding that goal is about 40%. So additional information is quite useful anytime, but particularly when margins are small. Now, we can look at any number of things in the world of uncertainty. You can look at production uncertainty. You can look at capital uncertainty. And you can certainly look at price uncertainty. We have found that including price in this look here, which is a Monte Carlo look, is not as useful looking at prices in scenarios. So we often want to know how our portfolio responds to different prices. And we could fold price into the Monte Carlo and continue to spread these bands out, right? So there's even more uncertainty based on price, or not on production, but on EBITDA or debt. But most people prefer to look at price as a scenario, and we'll show you examples of both. During times when things are highly uncertain and highly in flux, you're going to be asked, or you're going to be asking, depending on your position, for more scenarios to be run. You want to see them turned around quickly. You want to understand how your company's portfolio responds to a lot of different scenarios that can be imagined. And the secret here is that every scenario that's run, every what if that's answered, does not have to be board quality, fully forecasted down to the third decimal quality. It's okay when running these kind of scenarios, when trying to understand things, when trying to gain insight into things, to have a model that can quickly adjust to different prices. And you're seeing a graphic down here of the adjustment dashboard that was built into the little example model I'll be showing you some output from in a second, where prices can be changed, capital can be adjusted, OPEX can be adjusted, differential, and so forth, so that we can get a quick idea within a good amount of accuracy, but not absolute down to decimal accuracy of the response of our portfolio to different changes. And finally, about the opportunities we talked about. You know, a lot of companies look at buying and selling properties and projects, and they think about what is the value, what is the economic indicators, what are the economic indicators around that project. When you think of buying and selling in a portfolio view, you know, the idea that buying that project has cash flow and capital and all kinds of other considerations after it's bought. When you buy a project, it's going to require capital to run the project. That capital, unless it's completely self-sustaining, that capital will compete with capital in your portfolio and will fundamentally change your portfolio. At least it often will. And we need to understand when we buy and sell property, products like that, what is the deeper portfolio implication, not just did we buy a good project. What I'm showing here for the graphic is something else you'll be seeing as I show you the example. A number of projects, this in fact is our portfolio for our example project, a number of years, and in the grid, if a number shows up in the grid, that means that that project was chosen in that year that many times. So here's a resource type 2, curve 2, that can be chosen, it was chosen 35 times in 2016, where in International PDP Asia was chosen once in 2015. What we've done here is added a new project called Sell Asian Assets, which of course removes Asian production but gives us an immediate capital bump, so that that's an alternate choice between owning Asia and selling Asia. Therefore, we can let the sale or retention of the Asian projects become a part of the portfolio view. This over here is a quick dependency dialogue that we won't be getting into anymore because we're not actually showing a deep acquisition as part of the example. But this is showing that you can set up a dependency so that to make sure that you either keep your Asian projects or you sell them. You can't do both at the same time. So those are the 5 things that I'm thinking, 5 things that come to my mind that are different when we are in a volatile times. We need to survive the short term, so we need to have different goals in different time frames. We need to think about our financial metrics as well as our operational metrics. We need to consider uncertainty. We need to have a fast and flexible tool that lets us see a lot of scenarios quickly around price, around spending, around whatever we think is important to vary. And we need to be ready to take advantage of opportunities. So let me next show you a little example. It's a little story about a company, and I'm going to kind of tell you the story first so you don't have to have a murder mystery as I follow you along. It's a company that was looking okay at a reasonable price path, but they decided to test, see what they look like at a new feared and lower price path. They saw that price path threw them into a crisis. They decided on a course of action. They averted the near-term crisis, but in doing so, they sacrificed a good part of their future. In looking at alternate ways, we turn to alternate ways around that issue. We turn to optimization, and we look at two optimizations. One where they simply try to find the most value they can for that portfolio, and a second where they try to get good value for the portfolio, but also keep themselves in better shape for better times. That's where we're going, and I'll show you what we're talking about here. So I'm looking at two different price paths, and several times I'll vary between them. So I thought I would just show them to you. The starting price path is not a $100 or $90 price path at all. It's a pretty conservative price path by many people's standards, although today's prices are below them. In this price path, West Texas Intermediate starts at $55 in 2015, goes to $65 in 16, and then caps out at $75 for the remainder of the life. That is not an atypical price path these days. The one they want to test starts at $50, rises to $60, and then stays at $65 full time. So this also is probably not too unreasonable. You may argue that it's not going to keep flat forever, but I've seen this kind of price path used before. So we're going to look at the difference between price path 1 and price path 2, and how this company, this highly fictional company, responded to those changes. So this is the dashboard that we use to monitor the company's performance. So I'll spend a minute here and describe it to you. They look at 9 metrics simultaneously. And this is something that we at 3SI really emphasize with clients. Don't get so tied up in your 1 or 2 metrics that your company always talks about. You know, there are companies that always want to talk about EBITDA, or there are companies that only want to talk about production. And in these times, there's companies that only want to talk about debt. But every time you take a look at a scenario, we highly recommend that you keep an eye on a number of things. In this case, we're looking at production. And again, we have goals that are in red, and performance, which is in the red line. Looking at CapEx, looking at reserves, looking at EBITDA, net cash flow, debt. And down here we're seeing a look at production, CapEx, and reserves as split out by region. And there's a regional legend up here. So you can see that their base is U.S. onshore. They have some U.S. offshore. I'm looking at reserves right now as an example. A good amount of Asian production, and a lot of their growth seems to be coming from South America. Well, not much production shows up in South America, this blue wedge, before we stop looking at 2024. A good amount of their capital in the late years comes from South America, and a good amount of their reserves adds to. So it's a company that's coming along pretty well, and at the 55, 65, 70 price path, they're not looking too bad at all. They're staying in CapEx. Their their cash flow is growing. Their EBITDA is growing. Their reserves are fairly flat, which could be something for some concern, but they seem to be okay with it. Their debt under this scenario is actually dropping, so they probably could spend more if they thought they might. And their production grows until 2021. These pink bars, by the way, mean that we have that as a reference for what might be a target, but right now we're not enforcing it. We can add additional information by looking at the uncertainty. So here we have a considerable spread in production that just looking at the red line didn't let you know, is the P10, the P90. Production might in fact stay flat. A very considerable spread in CapEx, which probably reflects whether a large project is successful or not. And that large project is probably also reflected in this large upside to reserves, and so forth. We can see that on all of these there's some uncertainty banding growth. What we're going to be spending most of our attention on today, though, is the probability of making or staying under our debt limit. And you can see here, even though they have a great debt look in the long term, in the short term, there is some probability, just by the fact that they are drilling and looking at uncertain projects, that they might not make debt. It's about between 87 and 95% in these years here. So not a dramatically poor view, but they don't have absolutely certainty about being able to pay their debt under the current scenario. So let's take a look at what happens. One more time. These are the selections that cause this portfolio. So I know these selections don't mean much to anyone because it's a made-up portfolio, but you can see they are taking different investments in different areas over different time frames. Their late time frame seems to be mostly in resource. They've got some early spending in Asia and in the Middle East and South America and so forth. So we have a portfolio, we have the performance on expected value basis, and we have performance on uncertainty basis. Let's take a look what happened to this company when the price dropped. Here's the 50, 60, 65 scenario. It's the exact same set of selections. Nothing changed. We're just taking a look at what happens if price were to drop. Of course, production stays the same. Still the same wells producing the same thing. CapEx changes a little bit because we allowed capital spending to get a little cheaper when price dropped. We saw some correlation between capital and spending, so we're saving a little bit of money here in the capital. Reserves stay the same. EBITDA has dropped pretty dramatically. Cash flow is actually in crisis here. If we're trying to be neutral, we are at a negative $700 or so million of cash flow in this first year. And most importantly, for what we're talking about now is they have blown their debt ceiling. In fact, in this scenario, they never get back to their debt ceiling until 2024. And looking at probabilistics, their chances of getting under their debt ceiling with these projects being used are between 0 and as high in the late years as 40%, but most years around 25%. No better chance than that of meeting their debt ceiling. So they have a problem. If, in fact, they believe in the $50, $60, $65 price deck, they just got to look at what the future looks like, and they know they have to change. Here's a comparison, a direct comparison, to see a little better what happened between those two portfolios. You can see a small savings in capital, a large drop in EBITDA. The blue is the portfolio with the high price, or the medium price, and the red is the portfolio with the lower price. Definite gap in cash flow, dropped cash flow dramatically, and a huge difference in their ability to pay their debt. So in response to this, the company huddled up and made the decision that they would sell their Asian and Middle Eastern assets, these assets here shown in yellow. And it's interesting how the projects that get sold are sometimes chosen. Of course, there's analysis. I'm not saying there's not, but oftentimes it's what analysts have been telling them are not the best projects in their portfolio, or it's what they've received an offer for, or it's what a certain vice president really doesn't like. But in any case, they looked at their portfolio and they decided that they would see what happened if they were to sell their Asian and Middle Eastern assets. And they can quickly see that. So here is their view in the same look, selling Middle East. In fact, I didn't show you before, but when they started, the original value of the original portfolio was around $24 billion. And I'll show you a summary of this at the end of the webinar. When the price dropped, it dropped to a little over $4 billion. So actually, by selling their Middle Eastern Asian assets, they did make a bit of a profit there. They're now at about $4.7 billion. So between spending on projects that were probably not very economic, and whatever money they got, they've improved their portfolio value a little bit. They have dramatically dropped their production in the long term and the short term. They have dramatically dropped their reserves. They have fixed their debt pretty well. Their probability of making debt in the middle years is still around 70%, but they've, at least on an expected value basis, are able to make their debt payments. And their cash flow is mostly negative, mostly zero or a little bit better. First year is not quite so negative, but they still have about a $400 million shortfall. So a reasonably good way of surviving the immediate crisis, but maybe not the best way. If we look at this in comparison to the original portfolio at the low price, you can see how dramatically they've dropped production. The production now is in this red line. You can see they have dropped their CapEx, so they're saving some money there. Their cash flow is a little better in the first year. It goes back and forth. But their debt is just good enough now to get by. EBITDA is largely unchanged. Reserves are much lower. So their financial performance is not bad when they do this, but their volumetric performance is not good. At this price path, that's fine, but later on we're going to take a look at how these various portfolios behave when the prices change again. So we took a look at this portfolio using optimization. With optimization, we can name any number of constraints, things that must happen in order for the optimization to be considered valid. So these goals I've been talking to you about are constraints. So we must stay under the CapEx limit. We must stay under the debt limit. And we took away, for this particular example, the production requirement. We'll put it back in a minute. And we said, give us the best value portfolio you can, given those constraints. So get us out of our debt trouble. Keep us in CapEx world. And then show us the most value you can. And we could have added any other constraints we wanted to, right? We could have said we have to have a certain amount of reserves or so forth. But just to keep things simple, I kept it there. And the result was I found a portfolio by optimization that increased my value by almost $3 billion. Actually improved my probability of keeping my debt covenants in place. I'm now up around 75 to 80% in these years, and very good in the first couple of years. I've solved my cash flow negative issue, and in a lot of ways, I'm looking pretty good. If I compare this to the sales case, my production has increased nicely. Still not anywhere near where I used to want it to be, but it's increased nicely. My debt is looking better still, and my cash flow is looking quite a bit better. Here's the selections that got made in order to make that happen. That probably doesn't mean a lot to you, so I'll show you a different way of looking at the selections. In this view, a red number means that the second portfolio, alternate 1, had 50 less selections on the resource type curve 1 than did the sales case, so it shows up in red. It had 10 more selections in resource type curve 4 than did the sales case, so it shows up in black. So I can look at this and say, what changed between my sales case and my optimization? Well, I chose to get out of some early resource here. I chose to not sell some of my Asian projects. I retained the development project and the 2 development projects. This assumes, of course, that I can retain the development project without retaining the PDP or the existing production. I could have linked them, so that was impossible, but I didn't. So I choose to take back, not get rid of all of my Asia, not get rid of all my Middle East, rearrange my resource somewhat, and I chose to get out of the South America deepwater prospect. Those are the changes that the portfolio optimization suggested to me, and by doing those, I get greater value and better performance. But I told you earlier that we wanted to manage the short-term issue, which is debt, and also keep our long-term viability going. So I wanted to look at a portfolio that would actually keep my production growing, make sure that there was production around, make sure there were reserves around in the long term, but still solve my debt problem and still gave me good value. So I altered my production goals. I had them start at a lower level but grow steadily at 4%. I kept my other goals, my debt goal and my capital goal, intact. And my value now has dropped from the 7.2, I think we saw a minute ago, to a 6.7. So still considerably better than the 4 that I saw when I did my sale. But I've given up a little value here in order to keep my volumes growing. And why would I do that? The reason I do that is because I'm actually not certain about whether my price path that I've put in there is correct. And so I want to take a look at these new portfolios under different lenses, under the lens of what happens if a different price path comes along. And most positive price paths are going to take advantage of this growing production. There's other ways to do that in optimization, but this is a nice simple way that most people get, that I don't want to sacrifice all my production in a low price environment because prices could very well come back. I've now improved this is a comparison between alternative scenarios 1 and 2. Number 2 is in red here. You can see I've improved my production considerably. I've improved my reserves. I've actually improved my debt is about the same in the long term. And cash flow kind of falls back and forth. What changed? These are the selections, of course, for the original, for this new alternative 2. Hard to read, so what changed? We went to alternative 2. We actually came back and took back more of our PDP in Asia, so we didn't sell at all. We came back and retained all of our PDP in the Middle East. We postponed, so we're red here, which means we give up Middle Eastern development here, but we pick it up out here. Again, the model hasn't been told that it's not allowed to do that. We could tell it you can only do development in 1 or 2 years or something, but in this case, development was allowed to move, so it did move. So we brought back some of our existing production, didn't sell it. We postponed some of our projects here, and we postponed some projects here. So a pretty small change, except that not selling this is probably a pretty big deal. But in doing so, we retained some powder, some dry powder. And here's an example. Here's that same view, the one we just looked at, that same portfolio, those same selections, but now we've put the original price back in. So we're back to the 65, 75 portfolio. And our value in alternate 2 has now jumped to 23.7 billion, as opposed to the original portfolio the company started with, which was at 24.2 or 4 or something. So we've given up a little production. And at this new price, of course, our debt is very well behaved now, and if we get that new price, we don't have any danger of not paying our debt. Our cash flow is quite robust and so forth. So while alternative 2 is not quite as good as the original portfolio we saw when we first started this exercise, it's almost as good. It's very, very close. And it behaves much better in the low price environment that we face today. By the way, here's alternative 1, the one that was just based on value, and it now actually has a lower value at high price than alternative 2 did. So while it had the best value in a very low price environment, as soon as we switched to a medium price environment, the original price environment we saw, alternative 1 is not as viable as alternative 2, because alternative 2 was built with the future in mind. Comparing alternatives 1 and 2, I know I'm getting a lot of portfolios here for you to look at, but alternative 2 has better portfolio, has better production. It always did. A lot of the individual changes are minor, but the overall effect is a better value. And as price continues to rise, the value advantage of 2 over 1, and certainly over the original portfolios, or God forbid, the sales case, will continue to rise. Just a few other views. Here's the original portfolio, the portfolio after the sale, alternate 1 and alternate 2, looking at them and how things changed regionally. It's a view you can look at that could be quite illustrative when you're talking about portfolios in a strategic sense. So one thing management often wants to know is, how did things change besides just how am I performing better? What changed in my decision process? What have I done regionally to make things differently? So I talked about the original portfolio before. It's made up of onshore, offshore, U.S. onshore, U.S. offshore, Asia, Middle East, and South America. When we do the sales case, of course, the Middle Eastern and Asian pieces, these yellower pieces, drop out. When I go to my alternate 1, you can see that my Asian piece particularly came back in with a vengeance, but I dropped out my South America. A little bit of the Middle East came back. And when I went to alternative 2, I even did more of that. I bring in more of the Middle East. I modified my Asia a little bit, and South America stays out. So by looking at different optimizations under different scenarios, I can look regionally and see what's changing. What are my big changes? Here's a comparison of the values that we saw. Our opening plan had $24.7 billion of value. When the price dropped, it dropped to 4. And that's something quite interesting. Most people, or many people, don't realize how extremely nonlinear NPV is. NPV, of course, is the money left over after you've paid everything else. It's above break even. So a relatively small change in price can have a devastating effect on NPV, and that's what happened here. They lost $20 billion in value with a $5 to $10 price in oil price, drop in oil price. They came up with a solution that solved their near-term debt crisis, and they added $700 million or so in value by doing so. We came up using optimization with a much better value portfolio, also solved their debt crisis. Probably didn't do a very good job of solving their long-term issue because we didn't take it into account at this time, but we added almost $3 billion in value. We ran another portfolio that did take the long-term into account. We dropped about $1 billion in value, but looking at these two, here's alternative 1 at a higher price, alternative 2 at a higher price. When the prices rebound, if they do, alternative 2 has more value because it looked to the future. The sales case, by the way, selling the Middle East, even when prices returned, they were in real trouble. They'd lost almost more than $8 billion in value by the decision they made. Here's a look at how the probabilities went through at the low price for keeping their debt up. At the original portfolio, there was virtually no probability of meeting their debt covenants. When they made their sale, the first year looked quite good, and after that they were in the 70s. Alternative 1 increased that to the 75 to 80% chance, and by the time we get to alternative 2, we're up in the 85 and 90% chance of meeting our debt covenants. So what are some specific learnings about this portfolio? Number 1, we learned very quickly, just by changing prices, that the company is vulnerable to a $5 to $10 drop in oil price. Their value plummeted and their debt ceiling was violated. Selling Middle Eastern and Asian assets, which I call the knee-jerk solution here, a knee-jerk reaction, solved their near-term problem, did not put them in a very good shape for the long term. Using optimization, we found a better way, we found more value, by keeping some Asia, eliminating South America, and rearranging some resource investments. We looked a little deeper and found another scenario which let us keep most of our added value, but we kept our production growing. We continued to act like an oil company. And in doing so, when we pump a slightly higher price back in, our value increases. And if we look at higher and higher prices, the value will continue to increase. So that second scenario puts us in a better position should prices recover somewhat. What about the general learnings? What have I been trying to convey here to you for the last 40 minutes or so? I maintain that in this example and in many real-life examples, the ability to use financials as the fully functioning part of the optimization was critical. We don't want to adjust capital, look at cash flow, and hope that that is going to solve our debt problem. We want to run scenarios that take debt or EBITDA or net income or debt ratio, whatever it is that's concern of you in the financial world, into consideration as a part of the optimization and as a part of the scenario. The ability to quickly approximate the effect of different prices was critical. And I just used two prices and flipped back and forth. But I bet that you are getting questions about all sorts of price scenarios, all sorts of things. What happens if, what happens if, what happens if? If you can flip those around quickly and feel you're getting a strategic level solution, you are miles ahead of the game. The inclusion of uncertainty data in this particular example added considerable insight to the analysis. We were able to see the probability of meeting our debt goal, keep staying under our debt ceiling, and how that reacted to our various plans. And that was probably critical information in understanding what we needed to do and how we needed to do it. And there are multiple paths to near-term security. Some do a better job than others of protecting long-term viability. And we showed that by comparing two different optimizations, right? So even the optimization, if it isn't done with all the things you're worried about, is going to come up with the best answer for what you asked. It may not come up with the best answer for what you want to know. That takes some skill, that takes some experience, and that takes some thought. So finally, I showed you this example where we looked at two different prices and a couple of things. My question is, and I think anyone with experience has an answer, will management of this company stop here? Will they say, okay, thank you very much, I love your analysis, let's go home? No, in fact, the more you give them, the more they'll want. They'll ask for analysis at different prices. They'll decide that some projects need to be retained for whatever reason. They'll change the rules on you many times. My point is that is what they're supposed to do. Their job, among others of course, is to understand their business so thoroughly that they can respond to any change with knowledge about how that affects their present and how that affects their future. And they're going to do that by leaning on the planners, on the portfolio group, on the analysts, to give them useful information to make decisions with. One thing we have found is that if we have a system that's only capable of providing detailed, budget-level forecasts, those systems are extremely inflexible when dealing in a strategic world. Now, 3SI has tools that are built for that budget world, for that detail look. We're not opposed to that in the slightest. But when we are talking about strategy, we have to be flexible, we have to be fast, and we have to get insights. And Jeremy, that's about what I had as far as the presentation goes.
All right. Thank you very much, Jim, for that great presentation. And so now what we're going to do is open it up to some of the questions that came through the chat. So the first question is a simple one. So how long does an optimization generally take?
In these examples, as I was running these examples out, they were very fast, probably under 30 seconds. In real-life portfolios, that number can change quite a bit depending on how many dependencies are in it, how much complexity there is in it. But I'll tell you that I get very impatient when an optimization takes more than 3 minutes. Now, we have people that run optimizations that take 10 and maybe even 15 minutes. When they get over that, they tend to give us a call and ask them to help us get that back down. But I'd say to count on optimization taking 3 to 5 minutes.
Okay, good. And then the other question that we had was, what information is needed to calculate that uncertainty?
Right. So I didn't show you the data. We bring our data in generally through an economics engine. That could be through easymanage or it could be through PEEP or a number of other economics items. And for the uncertainty, what we ask you for is different outcomes for the same project. So when you do a project, the simple one is drilling an exploration well, right? On the simplest level, you can have a failure, which has its own cash flow implications, or you could have a success. And we'd bring in 2 outcomes called one failure, one success. We'd give them weights, so your chance of failure is 75%, your chance of success is 25%. If you want to get a little more sophisticated, we can start to describe success in a number of different ways. And the industry kind of goes towards the 30, 60, 90 log normal view, where we can have 3 different views, 3 different outcomes of success, and 1 or 2, maybe 2 or even 3 outcomes of failure. When we're talking about development projects, the chance of failure probably is gone, but the chance of delay can be quite high. So maybe 1 outcome is on schedule at 60% chance, and another outcome is a 2-year delay at a 40% chance. So whatever ways we can imagine that are substantive that something you have invested in might change, hopefully not as a result of a direct decision by you, but the directive forces somewhat out of your control. We bring those in, call them outcomes, and when we're looking for those uncertainties, we're running a Monte Carlo analysis and looking at it on a portfolio-wide basis.
Okay, thank you very much, Jim. And with that, that's the end of our webinar. If you have additional questions, you can send them directly to events@3si.com. And also check back at our website in a couple of days. We will post a recording of this webinar if you would like to view it again. Thank you everyone for joining, and have a great day.